Hey everyone, it's Imran from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment. We want to get this all over the place.
Okay, so another strong day yesterday. We had general dovish central banks and squeezy tech stocks kind of keep going. Nasdaq was up 3.5% on the day, which is another 2.4 sigma move. So this Nasdaq squeeze is getting pretty violent. Now things do look a little bit different overnight. We've had earnings misses from the big three, Apple, Amazon, and Google, and we've also got non-farm payrolls that are due. So we'll see how the market digests that. But we are already down 1.5 to 2%, probably about 1% now actually on the Nasdaq on the futures. Commodities were also heavy, gold especially, which have been flagging as a bit of a candidate to be shorting here, as it was showing some signs of exhaustion. So that's in need of a correction. I mean, anytime it's had a correction recently, it's been brought straight back, whether that's China or not is being speculated. But let's see how long this one can persist. But we did think gold was in need of a correction. I think it's going to depend a lot on what the dollar does. If the dollar does manage to actually stage a real bounce, then I think gold can come off. But for now, we haven't seen that all year. Volatility-wise, vol's firming up in the US. Starting to see a bit of spot up vol up price action here. But look at European vols. We'd literally flagged this yesterday. We'd said that we think European vols, the carry in European volatility was in the kind of 60-70%. And we said we think it's only holding up for Bank of England and ECB. And once those are out the way, we wouldn't be surprised to see implied vols get hit. Well, they've absolutely been annihilated, right? They're down about 2 vol points. So they're now down to 13 in Europe and 10 in FTSE, which is, levels we have not seen in ages. So, this is why you need to look at this dashboard. This is why these metrics matter, because they give you a heads up on what is likely to happen post an event, because the metrics don't lie, right? There was so much carry embedded in Europe. It just wasn't sustainable, right? And then that's why the vol got whacked. Also seeing a bit of a downtick in Nikkei and Nifty vols. Nifty stabilizing. Obviously, it's been under a bit of weakness with the Adani stuff hitting the news. So that's good to see some stabilization there. And then volatility-wise in commodities, we see generally a bit firmer. Copper vol still coming down, but that's had some pretty big carry in it. But in general, gold miners, oil, all firming up a little bit with regard to volatility. Skew-wise, we are seeing a mixed bag, but in general, I'd say skew probably better offered. You look at S&P skew back to the 3rd percentile here. European skews got whacked by about a vol point, so they're in the low single digits as well. So in general, skew coming off. No real stingy moves to the downside yet to spook the market. And then once those upside calls start to look way too cheap, then people don't want to sell those anymore. And if a bid comes back to upside, then you see that as skew flattening, basically. So that's kind of how that dynamic works. Okay, if we move on to some highlights, we've got obviously the animal spirits that have been ignited this week with the dovish messaging from central banks. Have taken the market higher. They all seem to be closer to pausing rate hikes than we maybe first thought. But that's obviously that animal spirits have been dampened somewhat by the earnings releases overnight. So we'll see. But, Microsoft did the same thing. They were down 4%. They finished like flat or up on the day. So let's see if these big cap techs do the same thing. But I'm not ruling out Nasdaq touching 13,000, to be honest, before this rally actually peters out. Amazon did have its first profit miss since 2016. Sorry, not Amazon, that was Apple. Amazon's AWS results were worse, and so was guidance. And then Google missed on both revenues and EPS. So pretty much, a dire set of earnings reports from those three. Nasdaq futures, as I said, were down about 1.5%. They are ticking up slightly now. Bond yields going lower, have been going lower for a bit. Recent disinflationary data and the European bond market especially had some of its wildest moves yesterday. Both Bank of England and ECB were interpreted as dovish. The drop in 10-year bond yields was the largest drop we've seen in over 10 years in terms of the daily move. And both euro and cable reversed early strength to finish down on the day. So those were kind of what the things we saw. Options activity absolutely exploding. So it does very much seem like the casino has reopened. Meme stocks are back. And then we could kind of call options on tech stocks an extension to the meme stock universe, right? So if you look here, the options volume hitting a record, going back to 2000 and where are we going back to 2000, I think, on this chart. I mean, the amount of options volume that's trading is ridiculous. And a lot of that is in the likes of Tesla, Amazon, etc. So, we are seeing least profitable and most shorted names rip to the upside as well. And that's obviously created a load of pain on the street for people who are underweight, but also it's created a lot of pain in the quant factor space. So the long short equity guys who run books in quant factor space, like quality, like momentum, whatever the other factors may be, they're seeing a bit of a blow up as well. So here you can see the daily performance. It's quite extreme that those sort of long short strategies were down 1.25%. You can see that's quite a big spike there, which basically shows there's quite a lot of blood on the street under the hood in terms of the way that the different style factors are moving and the way some of these momentum names are reversing last year's momentum and going sharply the other way, basically. Okay, and when you see moves like that, it's generally not a healthy thing, I would say, right? It's you start to see these sort of blow ups. It's not the sort of thing you generally see in a sustainable bull market. Now, if we look at ARK in a bit more detail, the question I'm posing is it time to fade this meme mania? Because that's clearly what we're going back into, right? And last year when we saw this type of mania in the memes, it generally was time to fade it. Now, if we look at the ARK basket, it's up about 52% off the lows in December. Pretty impressive in about a month. So YOLO type investing is coming back, whether it's low quality stocks, short dated out the money call options, whatever it is. But if we look at the technicals on ARK itself, and this goes back to last summer, you can see there's a volume shelf around here. Okay, so you can see on here there was a spike in volumes traded at these levels, basically. So that's what we call a volume shelf, and that can often act as a kind of support or resistance level. So that's one potential reason why maybe this rally needs to take a pause here. Another reason is if we look at this range from last summer, last August, back down to the lows, and then we do a fib retracement grid, we're right about that 61.8 retracement of that entire sell-off at this level at around 44 and a half. So this is potentially a good level where we could run out of steam. And then from a technical perspective, and then lastly, we're seeing bearish divergence in the momentum indicator as well. So as we're seeing higher prices, we're not seeing higher momentum readings, which again, often sets us up for what you could call a short-term exhaustion signal, right? So all things that make me think it's an opportune time to probably fade this ARK rally, right? So how would you do it? So, I mean, I'd look for I'm not looking for a crash in this thing, but, some sort of pullback to show that it's exhausted back into maybe zone between these two Fibonacci levels, between 38 and 42. That's kind of what I've got in mind. Okay. Now, if yields were to bounce a lot and yields was to go up again because we suddenly got inflationary data come back, then ARK could easily fall and even go back to the lows again. But I'm not sure if the bottom's in ARK or not. But what I do think is whether the bottom's in or whether we are starting a new leg higher in terms of the medium term, it's just overdone here, and it is very ripe for a pullback. So that's kind of the logic there. So how would I play that? So we go to the trusty Vol dashboard. It's looking at sort of somewhere between buying puts, bearish risk reversals, things like that. Now, I'm not comfortable selling calls in this stuff because the whole point of these short names and these squeezy names is you have no idea where these things can go, right? They can just keep going for a long time. And they have come down a lot, right? If we look at what they did last year. So I wouldn't be looking to do bearish risk reversals. So I wouldn't be looking to sell the call strike. So then it's like, okay, well, do you buy puts here? Well, vols have definitely spiked. Change on the week is up 5 vols. You look here, vols not quite as cheap as it was. This is kind of where this is where we have been. It has elevated slightly here in the 1 month space. So I'm more inclined to do put spreads because I still think an absolute level of 52 vol is not something I necessarily want to blindly just buy. We can see here the term structure has kind of popped a little bit. So just blindly buying a load of vol when it's popped 5 points on the week, you're kind of asking for trouble in terms of like the reset of vol and time decay as well. So I'm landing on put spreads. What put spread would I trade if I was trying to fade this move? And then the last thing to talk about is spot up, VIX up dynamic. First time in a while. This is something Brent at Spot Gamma has been talking about, and he thinks he's going to see this theme more and more this year. And I'm not going to argue with him. I think he's got a good point. So we can see here the orange line was the VIX. It started to really, when the S&P did start to break higher, the VIX kind of went with it. When we sort of accelerated through that 4140 area. So what drove that, right? There's a couple of things going on there. So firstly, Goldman Sachs have got their gamma profile analysis. So obviously, the likes of Spot Gamma have their gamma profile analysis, okay? And they make basic assumptions on where the longs and shorts are in the street. Now, the truth is, Goldman's have probably got a slightly better insight than all these other sort of retail targeted models have got, because they really do see the institutional flow. So Goldman's know if a big client has got a big OTC, which is an over-the-counter position that you can't see on the exchange, that is taking the street long or short. Goldman's will know if there was a load of 5 delta calls that traded that the models on the street are calling longs for dealers, but actually dealers are short that because they actually traded it and they know which way the client was. So you've got to actually, when you do get a look at the Goldman's model of gamma positioning, you should probably pay attention to it, because whilst the spot gamma model will have something that looks a bit like this, where the gamma will dissipate if the market keeps rallying, it won't collapse as fast as it is here. So this is suggesting that whilst the street is long $3 billion of gamma right here, if we rally 4%, the street's going to be flat, and it's even going to get short if we keep going up, which is quite interesting. It basically suggests that a load of low delta upside has been bought by clients, that dealers, right now it's not producing loads of gamma, but 4% higher, it's suddenly going to explode. And if you look at the fixed strike vol price action yesterday, when the S&P was up 1.5%, we're seeing a lot of green here, right? And we haven't been seeing that recently. Last week, and I've been flagging it, we've been seeing markets rallying, we've been seeing fixed strike upside getting killed and fixed strike downside going bid. Whereas here we see green across the curve. So suddenly there's been a bit of a reach for upside come back from the dealer community as we're starting to break higher, which again starts to confirm that yes, if we go higher from here, the dealers aren't going to be quite as long as we thought. And therefore, whilst we stay in this local zone, let's call it between 41 and 4,200, realized is likely to be pretty muted. But if we start getting to 4,300 and above, then there's nothing really pinning the market anymore, and realized vol could actually have a bit of a spike. So that's kind of the takeaway from this. And then the last thing is that there was a load of VIX calls that were bought, massive prints, like biggest prints we've seen in ages, 300,000 options trading across the March 24 calls and the 26 calls. That size of clip is pretty much equal to entire day's trading volume on VIX calls. And that was someone buying just those 2 clips of options. So someone felt the need to buy a crap load of March upside on the VIX. What it's against, why they're doing it, I have no idea. The options cost about 130 in terms of dollars. And I think that obviously helped with the whole VIX up, spot up dynamic, because whoever sold those call options would have had a load of VIX futures to buy to delta hedge them, basically, right? So that would have created a natural bid to the VIX, not allowing the VIX to go down anymore, even as S&P was going up. All right, a little bit longer than normal, but I thought this one was worth talking about, okay? So catch you all next week. Have a great weekend. I'll speak to you soon. Thanks.